Great. I hope you guys can hear me okay. My voice is a little bit croaky this afternoon. Those who've been listening to my podcast previously will probably be more familiar with my voice for radio, but it's sadly not here today. On the first panel, we have three small cap specialist fund managers, because most of this afternoon's discussion is going to be about small cap opportunities. And what we wanted to do is have a fairly open discussion with three portfolio managers who are all very familiar with the market and get the fund manager's view. What I thought we'd do to start off with, though, is introduce each of them separately. So, guys, if you could, starting with George, just give us a quick rundown on your fund and the area of the small caps market that you currently focus on.
Absolutely. Good afternoon, everyone. So George Ensor, I'm a portfolio manager at River and Mercantile. Been there for close to 10 years. I lead on our MicroCap investment trust, which is a £60 million investment trust. It invests in sub 100 million market cap companies. So we've had that since, it's actually our 9-year anniversary on Saturday for that fund. Strong long-term returns. Obviously recently been much tougher. And then I'm also lead on our open-ended small cap fund, which we've had since 2006. It was one of the first strategies that River and Mercantile launched. I've been lead on that for the last couple of years.
Richard.
I'm Richard Penny. I'm at CRUX, which is a boutique asset manager recently bought by Lansdowne Partners. I've been running the special situations fund at CRUX for 5 years, pretty much to the day. That's a multi-cap fund, large, mid and small, but with a bias towards small mid-cap. I've been doing small mid-cap for pretty much 32 years now. The highlight of that is we had 167% recovery out of the COVID. We tend to do well in rising markets. We did very well in 2009. We had a 150% recovery out of the GFC. And then a year ago, we launched a small cap fund, which is only sort of 6 or 7 million, with some of the partners from CRUX and now Lansdowne in that. We thought that was a really good time. The market was very cheap a year ago. We thought the UK was very undervalued. It's got more undervalued, but you know, that just talks to the opportunity, which I'm sure we'll be rehearsing over the next few minutes. But I mean, that fund, we've done an awful lot of work to be sort of plus or minus 1%, but there's an awful lot of value out there in small caps, but that's the next bit, isn't it?
And Steve, talking about Canada.
Yeah, Steve Palmer. I'm the CIO at Alpha North Asset Management. We run the Alpha North Partners Fund, which is a long bias small cap focused hedge fund. We focus on companies under 100 million market cap. It's a diversified fund. Where we really excel is in bear markets for the Canadian venture stocks. We've been managing money for 25 years in small cap, and then there's been 4 bull markets during that time. And on each occasion, we were the #1 performing fund in Canada.
Great. Well, I mean, you've touched on it already slightly, guys, but Steve, I mean, the small cap environment, how would you describe it at the moment from your perspective in the Canadian space?
The sentiment is quite brutal, actually. Like it's been 3 years since the market peaked in early 2021. I've never seen it as bad as it is currently. I've talked to some other people too that have been in the business for many years. One gentleman that's an investor with us, he's 90 years old. He's been doing this his whole life, investing in small cap Canadian companies. He said he's never seen it. Yeah, he said, what market? There's no market, there's no bids on anything. So to me, I'm a contrarian, so I see that as an opportunity, because if it can't get any worse, you know what's next.
Yeah. Richard, you've obviously been in the market for 30 years. I mean, is it the same from where you're sitting?
Yeah, it sounds like I'm just copying the playbook here, but you know, the talk in the market very much is this as bad as it's been? And usually the conclusion is that it is. In the UK, we've had 29 months of outflows, and that means that there's an awful lot of prices that look very cheap in mid-cap, but exceptionally cheap if you go down below 200 million, which we classify as micro-cap or the bottom 2% of the market. But actually, that is the type, when everything in hindsight looked obviously cheap, you kind of got to buy.
And George, you've been on the podcast. We've kicked this football around before virtually, but what's your feeling on the climate right now?
I think, as both of these guys have said, we're verging on unprecedented in terms of what's happened. So just focusing on the UK small cap market, we are today, if you go back to 2021 when the small cap market peaked, to today we're 34% relative loss against the all shares. The all shares gone up a little bit, high single digits. Small caps obviously well below where it was. If you look back to other periods of stress like COVID, financial crisis.com, you saw both large caps and small caps fall. Small caps tended to fall more, but they were still falling. So actually, you've got to go back to 89, 90, 91 for a greater period of relative underperformance. And actually, it only got to minus 38% then, and we touched minus 37 in the decline through November. So, we are actually 10% off the lows. Doesn't feel like that, but it got very oversold in October, and that got essentially to the same level that we saw the greatest drawdown you can see in the last 50 years in the UK.
And just somebody informed me this morning that 2022 and 2023 are two out of the 6 worst markets since 1955 in UK small cap. So, sorry, that's a bit random, but that's pretty bad to have it that. And usually, the downturn is a couple of years, 2.5 years, and then you get some of the really strongest bounce backs as people sentiment changes.
And Richard, where do you think we are in the cycle at the moment?
So I think we're at that point where people would recognise that valuations are very low relative to what invested capital and asset base is. What we're trading is difficult, and that's the experience of recent weeks. If you go down into small cap, mid cap, MicroCap, every other day there's a profit warning, and every 2 days there's a bid for a company. So when valuations are sort of low on a sort of 5-10 year basis, this is when the corporates and private equity and trade come in to buy things. And so 2 years ago they were floating everything. You can't float things now, and now they're buying things off the market. It's usually a good time to be buying.
And Steve, in the Canadian stocks, where do you think we are in the cycle there?
Well, one thing that gives me confidence, other than the negative sentiment that we're very near a bottom, is if you look at the data, and I have data since 1982 on the Canadian junior market, the best performing months of the year by far are December, January, and February. So we're right at that period where we expect some outperformance, and that period historically has been positive 78% of the time.
Right. So potentially quite close.
Yeah.
Talking in terms of catalysts, looking at it from the Canadian perspective, is there a catalyst you might anticipate that might turn the market around right now?
I think the main macro catalyst that's going to affect equities is just the mentality of everyone dwelling on the next interest rate hike, and is there going to be another one? When are they going to stop? I think it's unanimous now that it seems that most countries, the interest rate increases are over, and now the mindset's going to shift to when is the government's going to start cutting rates, and how fast are they going to come down?
Gotcha.
And in that environment, like declining interest rate environment, small caps typically do well.
Yeah, I mean, that's certainly the thing I'm looking for. What's your view, Richard? What's going to be the catalyst?
So I think there's an important point there, which is that sentiment can change incredibly quickly. So if you're looking for the economy to be the solution, actually it's the mindset of the investors that will move it. So I think this year that the dominant strategy is just buy everything in defensives in the UK, which it works. But then if that's the dominant mindset, and suddenly some of the cyclicals start to move, and these bids come through, and people haven't got them, then they have to move. And Investec, who comment on the UK mid-cap market, sort of say the UK mid-cap valuation is factoring in a 30% recession next year, which we clearly may not get. There is some bad news out there, but there's an awful lot of bad news in the price. So when it's like that and valuations are low, change in sentiment can be the real catalyst.
And George, I mean, there's a lot of talk about macro here. I mean, obviously the man on the street may look at small cap or micro cap investing as you're picking the real, value opportunities out there. But it does seem like, the macro factors, the geopolitical factors have really driven the valuations down. I mean, what do you, from your perspective, what are you looking for in terms of catalysts?
We've been speaking to clients for probably the last 6 or 9 months about a 4-point checklist for getting more constructive on equities in general, but small caps are very geared to that. If you want cheap valuations, we've made quite a strong case that you've got a 1 in 10 year opportunity in small cap valuations at the moment. In fact, relative to large caps, small cap valuations are even cheaper than they were in 08, 09. So you've got cheap valuations. You want to have peak interest rate and inflation expectations. So that was Steve's point, but the market should look forward and say, actually now we're no longer pricing in more hikes and higher inflation. And if you look back to about July time, the 3-year forward inflation that was priced into the market, implied in the market, was 6%. We've come down to 4.5%. I think 4.5% still feels quite high for per annum for the next 3 years. But nevertheless, we're past peak inflation expectations. Interest rates at that time were forecast to go up to 6.25%, 6.5%. We're now saying first rate cuts in the UK in May, so we're past that. You want to have the positioning and sentiment very negative. We've touched on sentiment and positioning. Just to add some data to the flows point, just for the open-ended small cap IA universe, so the 60-odd funds that fit into that universe. At the end of 2021, there was 19 billion of assets in that open-ended peer group. At the end of Q3, that had fallen to 9.8 billion. So that's partly performance, but it is also significantly flows. So you've seen that almost half. It's probably has half by now. The fourth point you want is probably the most contentious one, which is that you want the rate of economic deterioration to have started to improve. Things are getting bad less quickly. And we were making an argument for this earlier this year because the expectation set in the UK was so bad a year ago. And to put that into context, if you look at what the forward market for gas was pricing, which is one of the big problems we had in the UK, the forward price for gas today, last year, was 386 pence a therm. Today, gas is 108 pence a therm. So that the forecast that the Bank of England came out with saying we're in for the longest, worst recession since records began was all they forecast on forward prices, forward curves. So the expectation set got very, very negative. It then improved through the first half. GDP was being upgraded. Consumer demand held up much better than expected. Since then, we hit a bit of an air pocket over the summer and everyone got a bit worried again. Everyone got a bit worried that inflation was in the UK was stickier. We had a unique inflation problem. Since then, we've missed the Bank of England inflation forecast, I think, 4 or 5 months in a row. So we've recoupled with Europe and the US. So that Richard said that we might be in for bad news next year. So I don't think you can say a slam dunk on the fourth of those, that checklist. But those other 3, I'm pretty sure that you can put a big tick next to.
Gotcha. And if we talk about specific sectors within the sort of small cap, micro cap space, what do you think deserves love right now?
So we tend to think more about style than sectors. We think it's more important in terms of how we allocate capital in the market. So our philosophy is that we're life cycle investors and that companies generate capital generate shareholder value in different ways. And I think it's really difficult to work out what kind of style is going to lead next year. UK small caps have had a period of about 10 years where long duration growth, momentum, quality outperformed, and they were the dominant factors. And if you look at the strategies that were extremely successful in that growth phase that we went through from 2013 to 2021, it was those big long duration growth momentum funds that did extremely well. If we have a recession next year, you probably want to be long duration because rates are going to come down quite quickly, but you want to have quality. If inflation misses to the downside, which is definitely not consensual but could happen, then you probably want to go back into those long duration growth stocks. And if rates are going to stay high, so real positive real cost of capital, not as high as they are now, but perhaps 3 to 4% interest rates, then you do want to have more value and recovery in your portfolio. And so I think we're spending quite a lot of time we have actually been allocating quite a lot of capital to that recovery, margin recovery and asset-backed recovery style recently, but they can be across lots of different sectors.
Gotcha. And Richard, any from a sector perspective?
Yeah.
Anything you like the look of?
It would be led by mid-cap cyclicals, and they've got less far to go up, but they tend to go first because they're most liquid, and then it goes into the more contrarian calls. So, during the summer and in recent weeks, there are rescue rights done, so you can buy companies that would trade at £1 that get rescued at 5-10 pence, and the market we're in, they don't go up. But when you then look back at them, you go, well, you're buying for 5 or 10p, you're buying something that's it probably was only ever worth 50p, it might have traded at £1, but that still leaves you a lot of recovery potential. And, but it's not a mainstream strategy, but it's a recovery strategy. And when sentiment changes, those can be the things that really deliver outperformance, and they have done for us in previous downturns.
A lot of our readers are possibly wrongly obsessed with the idea of a 10-bagger, but what you're saying there is that there's a lot of companies that could easily fulfill that.
We have done research on 10-baggers and indeed 100-baggers, and what you find is that they usually start from a really difficult marketplace. A lot of the outperformance comes from a re-evaluation. It's not the driver of the earnings. The earnings go up, but it's economic recovery which drives the revenues, but it's also a re-evaluation and a massive change in how people are prepared to value things. And that's fairly consistent.
And Steve, which sectors are your favourites at the moment where you think we might see some recovery coming through?
Yeah, I can make a bull case for pretty much every sector in Canadian small cap. The Canadian market has more resource weighting than most. They've all been quite depressed. There's only been a couple really bright spots in lithium and uranium have been the subsectors that have performed well, but I'm nervous about lithium because there's just too many companies that have emerged, and the lithium price has kind of been in free fall the last few months. But given that all sectors could perform, like most bull markets in the Canadian small cap space have not had the participation of all sectors at the same time, other than the bull market from the pandemic lows in March 2020 to early 2021. That period had all sectors participating. It was, the result was a 237% increase in the TSX Venture Index in 12 months. Which made it the #1 performing broad-based index worldwide.
And speaking about Canada, it's obvious, as you already mentioned, it's quite driven by the resources sectors, and those are in turn driven by resources prices. Is that something that we would see happening? Is it suddenly there's a much bigger boost in some of these, say, for example, metals prices, that's going to have a feed-on effect into that Canadian small cap space?
I think it's starting to happen now. Like the US dollar has had some recent weakness, which is positive for resource pricing. We've seen gold go above 2,000, and many believe that it's beginning to break out. And Canada has a very high number of junior gold companies, so that would be very good for the market. So yeah.
And you've obviously been in the market for a very long time. Do you think this is an unusual cycle we're in terms of its dynamics? And would you expect an unusual recovery as well?
People always make comments at the bottom of the market often that, is it ever going to come back?
Yeah.
And what's the catalyst going to be? And often there's no particular catalyst. It's just sentiment just changes for whatever reason. And then FOMO kicks in, the stocks go up, and
yeah.
I think that there's a really interesting point there, which is people always get carried away with the structural bear or bull arguments at the top or bottom of the cycle. And you see a lot in the press at the moment about, the state of the UK capital markets and the equity market and the de-equitisation of the UK. And I get it, there are challenges there, and I think we do need reform, and the Edinburgh reforms, the Mansion House Accord, could be the beginning of something there, with capital coming into AIM-listed stocks. The BRISA was another thing that was obviously put to politicians recently. But we don't have to go back that far to remember 2021. There were companies IPOing in the UK with questionable business models coming on 4, 5, 6 times EV sales, being oversubscribed, and allocations weren't, sensible allocations weren't being made to long-term institutional investors. So people always get very carried away with where we are in the cycle at the moment, and the non-normal part of the last cycle was the 8 years of negative real interest rates. We've got small positive real interest rates at the moment. That's a relatively sensible place to be.
Yeah. Do you think there's still, from your perspective, still a sort of a pandemic hangover there from all the easy money that got pumped into the system? Or
I think some sectors still have a normalisation to go. I think the e-commerce stocks were a good group of stocks that obviously benefited hugely. There was a thesis that said, they're not going to give back these gains. It's going to be a structural step up in their market share. And funnily enough, they've all come back broadly to that trend line that all the e-commerce businesses were on prior to the pandemic. So most of that's played through now. Yeah. And most of the supply side shock has also played through now. That's why we're seeing deflation in quite a lot of input prices at the moment.
And Richard, I once was interviewing a very successful hedge fund manager who said that you could really call the market when we got to that point of maximum fear where everyone had just basically given up. That was the time to actually buy in. Is that?
Yeah, I was having lunch with a broker, I think 4 or 5 months ago. He said everybody's given up on valuation. Well, actually, everybody talks about doing valuation throughout the cycle, but the reality is when it matters most is at the top of the cycle and at the bottom when things are cheap. Yeah, there's always an excuse that somebody might be a seller lower down and avoid the flows. But actually, if it's cheap and you get these opportunities once every 10 years, you've got to find some way to get your head right to buy them. And it helps if you've done it 2 or 3 times before, as I think the guys here has done as well as we have.
Yeah.
There was a study done of the S&P returns. And there was 20 years, I think, to the end of 2020. And I'm not going to get the numbers 100% right, but say the average annual return was 8%. If you took out the 10 best trading days, you halved it. And if you took out the 20 best trading days, you made 0 return. So the returns are, the saying is timing the market, not timing the market. And that is why you get these very significant moves. And we did see some of them in the 250 in October. We had, I think, a couple of 3% days.
Gotcha.
I've looked at that as well. And what you find is those best days in the market occur near market bottoms.
Yeah, sure.
So if you're not in now, you're more than likely going to miss those days.
Yeah, no, very good point. Very good point. Well, thank you very much indeed, gentlemen. I've got a little bit of time for questions from the floor. So if anybody wishes to put one to our panel, it'd be great. Mark.
I have a comment and reflection. Comment is I've been in the junior mining space since 1986, and it feels like 80% of the time we're looking at this is the worst market I have ever seen. And then the other 20% of the time, you make all the money. My question is, shortly after the start of my career, the Big Bang happened in London. And since then, brokerage commissions have eroded to almost 0. Do you think that's had an extra effect at the microcap range? Brokers just don't go into the market anymore because there's nothing in it for them. They save their client cash for private placements exclusively. Do you think have you seen that effect, I guess, is my question.
I think that's touching on the kind of structural challenges. So I think absolutely that is one. Broker coverage has fallen away. So most microcaps will have one broker. It's the company Nomad. The research that they provide will tend to be quite short because they're no longer getting the research commission to employ more analysts and might write longer research. There is another problem as well, which is that a lot of the capital within the UK is either consolidating or moving to international benchmarks. Not long ago, most wealth managers had 20-30% of their assets in the UK. The UK is 4% of the ACWI World Index. Apple and Microsoft are currently larger than the UK. So there are absolutely structural problems there, but that is more than in the price. That is perhaps if we're trading at 13, 14, 15 times, those are relevant concerns. And there is a lot of momentum around this as well. The US, even if you take out the top 7, is trading above its long-term average. But, we know that ratings are geared into interest rates. So it doesn't make an awful lot of sense, but it's 60 or 70, I can't remember, % of the ACWI index, and capital goes passive, it goes into the US, it goes into those top 7 stocks, and they continue to go up. So there's a lot of momentum at play as well.
Anyone else? Trésor.
Hi, I'm Trésor Chauveau, and my question is for our two gentlemen from the UK, because I'm in the mining sector. And yesterday, there's been an article that Ivanhoe discovered made a huge deposit in the DRC for copper. And I'm involved myself in the mining sector. I have a concession in Namibia that I'm trying to list, talking to UK brokers and investors here. But the difference is, when I tend to talk to the UK, small cap and mid cap fund and company, they tend to be very reluctant, while when you talk to Canadians or Australians, with the same conditions, same assets, same risk, they tend to be more aggressive and they risk more. What do you think in terms of both, market condition? Why, in the same condition, they are willing to take more risk? Why here in the UK, they are a little bit frail?
I think there's more of a tradition of doing mining, and there's more sort of schools where they do mining, and there's more of a tradition of doing it in North America, Canada. We don't particularly specialize in mining. We tend to do more in technology and general growth businesses. I think the reason why they may be more aggressive at the minute is because, generally the level of outflows in the UK means there's a shortage of capital. You have all sorts of asymmetric risk in the small cap market, and particularly in the microcap market. You can buy businesses that will trade very close to cash that could possibly double. You can buy businesses that may have 50 to 100% downside if everything to go wrong. But if you do your work, you can mitigate that, and you can get, possibly 10 times upside for more cyclical conventional stocks. Project risk per se, I've usually shied away from, because it usually takes longer and costs more money to deliver it. And if you're in a market that's short of cash, which the UK market will recover and there will be cash available, but it won't be abundant. Usually you end up faced with putting more money in at a lower price if a project doesn't get delivered on time.
Yeah, the only thing I'd add is, from my experience, the UK market has increasingly moved away from anything that is not free cash flow positive. So even, relatively early stage tech businesses, if you're not free cash flow positive or very close to that inflection point, AIM investors, and obviously AIM is in London, and there's a lot of small cap capital in London that follows that, won't really consider it. And I say won't really, obviously some businesses have come and gone that have done that. And I think where you've got those very exploration license-led propositions, you need to have very specialist people considering them. And you either have those in abundance or you don't. And I don't think we've got that mindset in the London small cap market anymore. people that I know who did do it have done it for the last 20 years, and to your point, they've had outflows. They've had to sell, these projects at the wrong valuation, and that's played out.
Time for one more question before we move on, if anyone has one. Look, great. Look, oh, sorry. One.
Thank you. It's both encouraging and discouraging to hear your take on just the state of the markets, as it were. One question I had is surrounding ESGs, actually ESG plays and small cap companies in that space. How are they doing in these markets? How are they faring in any of the E or the S of these markets? Love to hear more about that as well.
Well, in the Canadian market, I think they're just the same as any of the other companies. There's no,
So it's all the same.
all the same, yeah.
I think a lot of the ESG plays quite often were about new technologies and sort of all way out there on the risk and growth curve. And the market, when rates start going up, the market moves away from that and it goes very risk averse. And so it kind of felt like a voting machine, and there wasn't perhaps full disclosure that these were very early companies for pure ESG funds. And then now there's a recognition that you're taking on quite a lot of risk, and there's capital losses, people are less keen.
Great. Well, thank you very much indeed, guys, for your insights today. It's been really, really valuable. Yes, just round of applause for our fund managers.